Welcome.
Thanks for having me, Tim.
Awesome. Let's jump into how did you get into this world of real estate and have the guts to cash advance $97,000 of a credit card to get started here?
Yeah, I was raised by two immigrants from Brazil, and I was always taught that you go to school, get good grades, and then once you're done, you go out into the real world, get a job at a Fortune 500 company, and then you retire with a pension after 30, 40 years. Unfortunately for them, when I was 16, I read Rich Dad, Poor Dad, and that changed the way I looked at the entire world. I started getting my hands on any book I could that had to do with business building, business ownership, real estate investing, etc. I still did go and get my engineering degree at University of Illinois, but very quickly after actually getting a job at a Fortune 50 company that had a pension, I lasted about 13 months before I quit to start doing real estate full time. So I quit. I applied for something like 64 credit cards in one night. 12 or
Wow.
13 were approved, and then I cash advanced like $97,000 off those cards, and that's how I started. So first in the residential space, small single family homes, duplexes, not only doing contract assignments but fix and flips. And then I started saving some money for some down payment, holding rentals, and then started scaling those rentals up to apartment buildings. And then around 2016, I started to get really tired of being a landlord. I turned into one of those tired landlords that everybody else looks for. And I realized there has to be a better way than allowing people to live inside of your investments. And when they don't pay and you have to get them out for stealing rent, basically, then they have the ability to trash your investment that can usually cause anywhere between 1 to 3 years of lost profitability. So that's
Yeah.
when I started to look at different asset classes. I narrowed them down to three and then eventually down to one. And I eventually I chose self storage because I didn't have to deal with the three T's: no tenants, no toilets, no trash. And ever since then, started us doing contract assignments on self storage in 2016. In 2018, after I proved the concept using the wholesaling model that I was able to buy facilities at deeper prices and sell them to more sophisticated operators than myself, then we started to raise capital and buy our own deals. So 2018, I bought my first self storage facility. And then now here in 2025, we've done more than 54 facilities across 24 states, almost about $250 million worth of self-storage. And that wasn't just me. I have to really thank all my investors. We have 822 investors as of today that invested in all of our projects. Many of them have been through multiple life cycles with us, been paid out and then reinvested. So I really got to put the thanks on them.
Very good. That's excellent. Yeah. We all start with, I think, wholesaling, fix and flip is like the most common way that many of us get started. And then landlording is the other most common ways. So when you narrow down to the three assets that you want to focus in on, what were the other two besides self-storage?
Yeah, so one was data centers and the other one was mobile home
Ah,
parks. And here's the
I
reason why
see.
I'd choose those two. So first, data centers, if you want to build a data center that is easy to exit, you're going to need about $100 million in equity to start. So that was already too big of a goal for, at the time, I think I was 24 years old. So I decided not to do that. And then when I was looking at mobile home parks, I spoke with some of the investors that I've known that are in the space. And they said, Fernando, listen, yes, you're not a landlord technically. You only own the lot and people pay you lot rent. But guess what? People stop paying on their houses. Then you have to repossess those houses. Then all of a sudden now you have park owned homes that you have to rent out just a landlord would. So if you're trying to get away from tenants, toilets, and trash, mobile homes is not it's not the way to go. So I think that the decision was made for me.
That's all. That's awesome. Interesting you mentioned data center. These days, the last couple of years, ever since OpenAI made ChatGPT popular, data center is a huge trend right now, especially among the bigger players, family offices, institutional players. They're putting quite a bit of money there. So that's, yeah. So now that you're used to doing bigger deals, you might want to revisit that idea. But yeah, I know one of the developers here in Texas, he's building six data center. He's doing his fund is like a little bit over $1 billion fund to do
Mm.
these data centers with. So yeah, it's a really interesting business model there. But So self-storage, you got in at a really good time, 2015, 16. I think at that time there was still fairly a good amount of like mom and pop type owners for self-storage. Is it still that way now? How is it now 10 years later in that space? What has changed in that space?
Yeah, absolutely. It has moved a little bit, but it's not nowhere near where, let's say, multifamily is. For example, the amount of consolidation that needs to be done in the self-storage space to meet the level of consolidation in multifamily, it's going to take about 30 years. So
Oh,
right now,
wow.
of the anywhere between 55 to 70,000 self-storage facilities in the United States, 18% of them are owned by the top six publicly traded real estate investment trusts. Then the next total 100 operators, which I'm a part of, we're number 96. Those investors own another 12%, which means that
Mm,
roughly 70% of the entire self-storage stock in the United States are owned by mom and pop operators. So right now, the way to profit in self-storage is consolidation. And that's one of the three legs of the stool that we have in our business is buying these mom and pop shops, institutionalizing them, expanding the footprint, putting in professional management in place, and then packaging them up into 10 to 20 property portfolios and then selling them up to the larger fish.
I see. Very cool. So what size deals are you looking for? Is there a minimum? Is there a maximum? Give us some ideas around that.
Yeah, so we have three different buy boxes, right? So if we're going to buy it, we need that facility to be of institutional grade within the end of our investment period. So typically we hold assets on average for about 3 years, 4 months. I need to get that above 65,000 net rentable square feet. That doesn't mean that I won't buy
Okay.
lower. I'll buy as low as 35,000 net rentable square feet as long as it comes with land that I can expand on to then get it up to an institutional sized asset. Now, that being said, we also still do the wholesaling, right? Because that's a great way to bring in fees to pay for kind of the keeping the lights on while we're doing these value add strategies for our investors. So on our wholesale side, we have about 4,000 buyers, self-storage buyers on our list. And on those ones, we'll go down to 20,000 square feet because there are some new self-storage operators out there that are willing to take smaller deals. My very first deal that I bought outside of Chicago was 16,995 square feet. So just
Mm,
shy of 17,000 square feet. So that you can still make money on those deals, but once you get up to the scale that we're at, it's better to let those one-off go to some of our operator partners that are on our wholesale list, and then we focus on the more institutional grade assets.
I see. Very interesting. Okay. What about markets? Like all of your assets in primary markets, secondary markets? Yeah, give us some insights into how the different markets play a role in competition and
Right.
yeah, things like that.
Yeah, so self-storage, unlike, let's say, apartment buildings, has very hyper-localized trade markets. So, for example, you can't say, hey, is Chicago saturated? You can't even say, are certain neighborhoods in Chicago saturated? Is Lincoln Park saturated? Is Lakeview saturated? You can't say that because typically these trade areas are anywhere between a 5 to 10 minute drive time or roughly 1 to 3 mile radius around that self-storage facility. Now, if you go into a little bit more rural of an area, secondary, tertiary market, that trade area can expand up to 5 miles or roughly 15-minute drive time around that facility. But we look at all assets across the lower 48 states. We market to except for Hawaii and Alaska, we market to all of the states. And each one of those locations, if it's a primary, secondary, tertiary market, has usually a different strategy, right? So, secondary and tertiary markets, those are great to build up portfolios, consolidate all the smaller mom and pop, become
Mm,
a monster in that market where you basically control the rents and then sell those off to a larger operator that has more of a regional portfolio. These are going to be the types of deals that you buy that are usually cash flowing very well. The secondary and tertiary market deals may not have websites. They may not be on Google My Business. They may be overpaying for the large expense items like property taxes and insurance just because they've never contested their property taxes or they haven't rolled up their insurance into a portfolio like we are able to do to get better per unit pricing. But when you go into the primary markets, then the strategy changes a little bit because primary markets are already somewhat popular with the larger operators. The top 20 operators really like these primary top 50 MSAs. So usually what you want to do in those markets, or what we like to do, is we'll go to one of the bedroom communities. So for example, if anyone out there is familiar with Chicago, you have an area called Naperville. It's not technically in Chicago, it's a suburb of Chicago, but it's a great place to build. It's about a 45-minute drive. So we do this all the time. For example, we're doing this in Charlotte, we're doing this in Atlanta. So in Atlanta, we're building in a city called Lawrenceville, which is a 30, 40-minute drive from Atlanta itself. We usually are looking for development opportunities in these type of primary markets. So we look at where the path of progress is. We go out in that path of progress and we buy a land package for typically something that is not zoned for self-storage, because then allows us to
Mm,
grab that piece of land for much cheaper, typically less than $500,000 for the entire land package. And typically we're looking for anywhere between 4 to 25 acres is what we're looking to build on. And then we'll put up an institutional grade Class A facility. So that's going to be a 3 or 4 story self-storage
mm,
facility, 100% climate control. Usually it's going to be anywhere between 90 to 120,000 net rentable square feet. And we're going to be charging top of the market rents for those types of units.